Welcome back to the deep dive, where we take that overwhelming mountain of information, the stack of articles, research papers, and policy reviews you provided, and really try to distill it all down.
Right, down to the essential, the surprising, and hopefully the truly actionable knowledge.
And if you're joining us for this particular deep dive, you might be thinking about the future.
Right.
Maybe looking at wealth building or risk mitigation.
And while most people, I think, immediately think about insuring their assets, a house, a car, maybe even their stock portfolio,
Sure, the tangible stuff.
the tangible stuff. Today, we're focusing on what is, without a doubt, the single most valuable and often the most vulnerable asset that you possess.
And that is your ability to earn an income.
Exactly. Your capacity to perform what the source material we looked at repeatedly calls those core work functions.
Such a fundamental disconnect, isn't it, in financial
Yeah.
planning? We spend so much time and capital ensuring the things that store wealth.
The object.
The objects, right. But we sometimes completely overlook ensuring the actual mechanism that generates all of that wealth in the first place,
Your body and your mind.
your body and your mind. And what happens if that engine suddenly stalls? What if a physical impairment or an incapacity to work and this is a really vital inclusion in modern policies,
No, absolutely.
the inability to maintain composure because of, say, a severe psychological disorder?
Yeah.
What happens when that suddenly stops the paycheck?
That is the core question we're answering today. I mean, that's what we're here to dissect, what is known broadly as disability insurance or DI.
Right, DI.
And depending on the context, you'll also hear it called disability income insurance, or my favorite term, which is probably the most descriptive, income protection.
Income protection, I like that. It's very direct.
It is. Its purpose is just foundational to modern financial security. It's about guarding your earned income against these unexpected, often life-altering risks.
So when we talk about this whole umbrella of income protection, we should probably be clear about the scope, because it isn't just one single product, is it?
No, not at all. According to our sources, DI really encompasses a whole spectrum of benefits. It can range from, very short-term employer provisions like paid sick leave.
Okay, so that counts.
That counts, yes. And then you move up to short-term disability or STD. And then finally, you have the really comprehensive backstop of long-term disability LTD benefits.
This is all housed under this single discipline.
It is. So, okay, let's try to unpack this landscape. Our mission for this deep dive is to move quickly, but thoroughly through this incredibly complex area.
Right.
We want to understand not just the mechanics of the modern policies, but also, the history, the historical context of income protection.
And then the modern types of coverage that are available, the private, the governmental, the employer-provided plans.
And crucially, figure out how all these different safety nets are designed to interact and in some cases overlap.
The goal here for you is really demystification. We want to take this, this often ignored area of financial planning and just show you how it operates.
And it operates on multiple really distinct levels.
Exactly. So at the very base, you've got these massive national programs like Social Security in the U.S., which are designed purely as a floor. The idea is to prevent, as the source material puts it, abject poverty.
But then at the complete other end of the spectrum, at the very top, you have this niche, highly specialized private market.
Okay.
And this market designs policies to protect the really high earners. Think of specialist surgeons, corporate executives, successful small business owners.
People who need their replacement income to keep pace with, seven-figure pre-disability earnings.
Precisely. And understanding that vast difference in function from a basic safety net to, specialized asset protection, that is absolutely key to being well-informed about your own financial stability and your own planning.
Now, here's where we take a step back and look at the origin story, because this is where I think it gets really interesting.
It does.
When you hear disability insurance, you naturally think of, modern offices, actuaries with supercomputers, complex risk modeling, that sort of thing.
Sure. The modern insurance industry.
Right. But the true origin story of this specific type of protection is, surprising. It's rooted entirely in 19th century Industrial Revolution transportation.
That's right. The whole concept of insuring against the inability to work because of a non-fatal event, which is distinct from simple life insurance, it started under a much, much narrower banner.
Which was?
Accident insurance. And the catalyst for the entire industry was the rapid and, frankly, terrifying expansion of the railway system.
Yes. The founding moment is so specific, it's almost cinematic. It's the Railway Passengers Assurance Company, which was formed in England way back in 1848.
I love that. The creation of this massive new industry was driven by a single new technological risk, a risk that just fundamentally changed how people traveled and how frequently they were getting injured.
You have to put yourself in that mindset.
You really do. Think about the socioeconomic landscape of the 1840s. Travel was, for the most part, slow. It was local. It was pretty predictable.
Horses, carriages.
Exactly. Then, all of a sudden, you have trains moving people across the countryside at speeds and volumes that were never before imagined.
And this new technology created a massive, immediate, and very visible new risk.
Catastrophic risk. High-speed, multi-casualty accidents. This was a type of risk that the existing insurance framework, which, mainly covered things like property or just death, it just couldn't properly address it.
So this company, which was originally called the Universal Casualty Compensation Company,
Right.
was created to tackle exactly that problem. Their mandate was, well, it's twofold. First, to grant assurances on the lives of persons traveling by railway. So that's the life insurance part.
Right.
But, and this is crucial for our discussion, also to provide compensation to the assured for injuries received in non-fatal accidents.
Yeah.
That latter clause, that's the DNA of modern DI.
And their business model, even way back then, showed an incredible grasp of, convenience and risk aggregation.
How so?
Well, they didn't just sell policies through brokers in an office somewhere. They struck a direct deal with the railway operators themselves.
So they sold it right at the source of the risk.
Exactly. They sold basic accident insurance as a package deal right along with the travel tickets. You'd buy your ticket, and you'd have the option to buy a little insurance policy right there on the platform, maybe just to cover that one specific journey.
The genius of that is putting the product exactly where the risk is being assumed by the customer. But what's really fascinating here is how quickly genuine risk assessment, the foundation of modern underwriting, entered the picture.
Absolutely. The sources note that almost immediately the company charged higher premiums for second and third class travel.
Now that sounds like simple class discrimination.
It does, but it wasn't, not in the modern sense. It was a pure actuarial decision.
Okay, so why?
Because of the higher risk of injury that was inherent in the third class roofless carriages.
Roofless carriages. So the actual design of the vehicle itself became an actuarial input.
It did. Think about that for a moment. You have travelers sitting in these open-air cars, exposed to the elements, soot, sparks from the engine.
And a much higher probability of being ejected or hit by debris if there's an accident.
A much higher probability than someone sitting in the enclosed, slightly more robust first-class cabin. It's a perfect historical illustration of risk-based underwriting.
They weren't just insuring against the possibility of an accident.
No, they were calculating the verifiable likelihood of a person in a roofless carriage sustaining an injury versus someone who was protected inside the first-class compartment.
So this shows that, 170 plus years ago, they immediately recognized that the premium cost has to link directly to verifiable risk exposure and the environment.
That's the fundamental DNA of modern insurance, and it was established right there on those Victorian railway platforms.
Okay, so let's fast forward 150-odd years. The private protection landscape is now incredibly complex and global. So if you're self-employed or if your employer just doesn't provide enough in-benefits, or maybe any at all, you have to start looking into securing what's called individual disability insurance, or IDI.
And IDI is where the customization is, well, it's both a blessing and a curse.
How do you mean?
Well, it's a necessary step for high earners and for anyone outside of those traditional corporate safety nets, but it's not a simple one-size-fits-all group policy. It's tailored to the individual.
So there's a lot of variability.
A huge amount. The source material really emphasizes that premiums and the benefits you can get for individual coverage vary considerably between companies, occupations, states, and countries.
And that variability makes sense, right? Because you, the listener, are shopping for a policy that has to cover your specific risk, not the average risk of 1,000 other employees.
Exactly.
So let's talk about the key factors that drive those costs and benefits, because this is where someone who is comparing policies really needs to focus their attention. Our sources list 4 critical factors, and they all seem to be about defining the exact risk the insurer is taking on.
Precisely. The first 2 are quantitative and pretty straightforward. First is the level of monthly benefits provided.
So the dollar amount.
The dollar amount. And second is the benefit period. That is, how long do the payments last?
Okay, so if you want, say, $15,000 a month until you're 67.
That's an astronomical level of risk for the insurance carrier compared to a policy that only pays out, say, $4,000 a month for just 5 years. The duration and the amount, they define the maximum payout exposure for the insurer.
Then you have the third factor, the elimination period, which is basically your waiting period,
Yeah.
a deductible period.
Yes. How quickly do the benefits start after you file a disability claim? And this is a really crucial area for financial planning.
Because if you want coverage that kicks in after only 30 days, you're going to pay a phenomenal premium.
A huge premium. Because the insurer knows that many, many short-term illnesses or injuries will resolve themselves within 60 or 90 days.
So it's an explicit trade-off. If you have enough emergency savings to cover yourself for 6 months, or if your employer gives you 90 days of sick leave or short-term disability,
Then you can set your elimination period for 180 days, and your premium will drop dramatically. It's a direct calculation where your own savings capacity directly mitigates the risk premium you have to pay.
but the single most important and often the most costly factor is the fourth one,
Right.
and that's the definition of disability. Our sources highlight that the premiums tend to be substantially higher for policies that define disability in, quote, broader terms. This factor is the absolute make-or-break element of an IDI policy.
You cannot stress this enough. This is the technical distinction that separates a policy that truly protects a specialized career from one that is, frankly, practically useless for a high earner.
And it all boils down to this massive divide between two concepts, own occupation and any occupation.
That's the divide.
So let's break it down in detail. A restrictive policy, the one that costs less, will typically use an any occupation definition.
Right. And that policy might say you are only considered disabled if you can't perform any job for which you are reasonably suited, based on your education or experience.
Or even more restrictively, sometimes it just says you can't perform any gainful activity at all.
Which is an incredibly high bar.
So let's use an example. A highly paid corporate lawyer.
Okay.
Let's say they develop severe chronic back pain that prevents them from sitting for hours in court or in long meetings.
And any occupation policy might argue that they are not disabled
Why?
because they could still work as a consultant or teach law or maybe take on a lower stress administrative role, even if that new job only pays 20% of their pre-disability income.
So because they are still technically employed, the policy doesn't pay.
Exactly. The policy says you can do an occupation so you're not disabled.
That is financially devastating. It completely defeats the whole purpose of income protection, which is supposed to protect the specialized value of your existing career.
It does. And this is precisely why high earners pay for the broader and much more expensive own occupation coverage.
So how does that work?
An own occupation policy says you are disabled if you can't perform the specific functions of your current highly paid profession.
Okay, let's use another example. A hand surgeon.
Perfect example. A hand surgeon who loses the fine motor skills required for complex procedures because of nerve damage.
They can't perform surgery anymore.
No, but they can still think, they can teach, they can consult, but they cannot perform the core duties of being a hand surgeon. An own occupation policy recognizes that they have lost the capacity to perform the job that generated their high income.
And so they receive their full benefits.
They receive full benefits even if they choose to go and teach or consult for a lower income.
So it's the difference between protecting your skill set versus protecting your bare minimum earning capacity.
Yeah. That is the perfect way to put it. And the broader that own occupation definition, especially those policies that pay if you are disabled from your job, even if you take another job, the more protected your specialized income is.
But the premium is going to be much, much higher.
Of course. And this complexity is why the source material mentions the existence of web-based disability insurance calculators.
Right.
For you, the listener, these tools are vital, not just for figuring out how much cash flow you need, but for helping you understand the premium differences that come with customizing those 4 factors we just discussed.
It's about bridging that gap between a sophisticated lifestyle and whatever government or employer safety net you might have.
Exactly.
So moving beyond that standard IDI, we get into a really specialized area called high-limit disability insurance.
We do.
So if you are a top executive or a highly paid professional athlete or a medical specialist making, $800,000 million or more a year,
Standard IDI policies just won't cut it. They often cap out around $15,000 or maybe $20,000 a month in benefits.
which leaves a massive, completely unacceptable hole in your replacement income.
A huge gap. And that gap exists because standard insurance carriers need to diversify their risk. They typically don't want to place, say, a $500,000 annual payout risk on a single individual.
It's too concentrated.
It's too concentrated. Their risk pooling just limits what they can safely insure for one person. And this is where high-limit DI steps in.
And the goal of this specialized coverage is what? Singular and clear?
Very clear. It's designed to keep your total individual disability benefits. So that's combining your standard policies, any group policies, and this new high-limit policy at a set percentage.
Usually around 65% of your earned income.
You're right. Around 65%, regardless of how high that income is.
And this high-limit coverage is almost always issued supplemental to standard coverage.
It is. It's not a primary policy. It's designed specifically to top up the difference between what your primary policy will pay and that 65% replacement income target.
And the potential benefits are, well, they're astronomical. They have to be.
Yeah.
To reflect the immense salaries they're protecting.
They are. The sources tell us that the additional benefits provided by high-limit disability insurance can be anywhere from an extra $2,000 all the way up to $100,000 a month.
$100,000 a month. That represents a huge portion of financial risk concentrated on very few, very high-earning individuals.
It does. And to give that some more context, the source mentions that a single policy issue and participation coverage has been known to go up to $30,000 a month. And it cites specific high-income sectors, like hospitals.
Right. You think of the specialized neurosurgeons or interventional cardiologists.
Exactly. If they are disabled, the income stream they lose is so vast that the private market has to step in with specialized capital to cover that risk. It really highlights the vast capital being protected in these crucial and demanding fields.
So now we need to transition. We've been talking about protecting the individual's paycheck, but let's look at a related but entirely distinct form of private protection. One that's vital for entrepreneurs and business owners. Business overhead expense, or BOE coverage.
This is a really crucial distinction that often gets confused. A BOE policy is designed to protect the business, not the owner's personal income stream.
Although, of course, protecting the business is existential.
It is, because if the business fails, the owner's income stream dries up completely anyway.
So this policy is the lifeline that's designed to keep the lights on and the doors open.
Pretty much. If the owner of a professional practice, let's say a small manufacturing firm, an independent accounting office, or a busy dental practice, if that owner experiences a disability, the BOE policy reimburses the business for the overhead expenses it still has to pay.
This allows the business to continue operating, maybe at a reduced capacity, until the owner can come back, or the business can be successfully sold or transferred.
Absolutely. Without it, the disability of the owner almost guarantees the death of the business.
The detailed list of eligible expenses in the source material is really important because it shows just how broad this policy is. It's comprehensive for operational needs.
It is. It'll cover rent or mortgage payments, utilities, leasing costs for equipment, all the basic physical overhead.
But it goes much deeper into the administrative necessities.
It does. It covers things like laundry and maintenance fees, and, critically, accounting, billing, and collection service fees. Basically anything that's required to make sure the firm maintains its administration, its cash flow, and its regulatory compliance, even if the owner isn't there or actively working.
And here is maybe the most critical detail for business continuity, one that speaks directly to staff retention.
Which is?
BOE covers employee salaries and employee benefits.
This is the genius of the coverage. If the owner is disabled for 6 months, the business can use the BOE payout to retain its core team, its most valuable paralegals, its specialized technicians, its experienced office managers.
Because if you lose your talent pool because you can't pay them.
The business infrastructure just collapses, and recovery becomes nearly impossible.
So it's not just a payment policy, it's protection against the complete failure of the business due to the temporary absence of its primary driver.
Right. And it also covers things like property tax and other regular monthly expenses, making it a really comprehensive shield for all those ongoing financial commitments that don't just start because the owner is ill or injured.
Okay, so we've now explored this highly flexible, highly tailored, and let's be honest, often expensive world of private insurance.
We have.
But for most of the population, the absolute foundation of income protection is the social safety net that's provided by the government.
That's the crucial pivot. In virtually all developed countries, the National Social Insurance Program is the single most important form of disability insurance. It is the bedrock that the entire system rests upon.
So in the UK, we'd see this under the National Insurance Scheme.
Right. And in the U.S., we're talking about Social Security specifically, Social Security Disability Insurance, SSDI, and also Supplemental Security Income, or SSI.
And the core importance of these programs, it really can't be overstated.
No, it can't. They provide what our sources call a floor beneath all other disability insurance. If you are uninsured or just grossly underinsured, these massive governmental programs are designed to catch everyone.
They're enormous systems, supporting millions of beneficiaries. And the key distinction here is their purpose.
The purpose is everything. The general theory behind the benefit formula is that the amount they provide is sufficient only to prevent abject poverty.
It is not designed to replace a $200,000 salary.
Not even close. It's designed to ensure basic survival and a measure of dignity.
So if that's the case, does relying solely on something like SSDI actually become a financial trap for people who were previously high earners?
That is the painful reality. For a high earner, SSDI can become a poverty trap. And what's more, the definition of disability for SSDI is notoriously strict.
Stricter than private insurance.
Much stricter. You must be unable to engage in any substantial gainful activity, and the disability must be expected to last for at least 1 year or result in death. It's an exceptionally high bar, and it often leads to years of administrative back and forth.
And we have to mention the timing hurdle as well. Even once you're approved, SSBI benefits don't start immediately, do they?
Not at all. There is a 5-month waiting period after the onset of the disability before any benefits begin. And this is yet another one of those gaps that private IDI or STD policies are specifically designed to bridge.
So moving from that national safety net, the second largest form of DI is the kind that's provided by employers.
Right.
And the sources note a very logical reason for this prevalence. One of those common reasons for disability is on-the-job injury.
And while on-the-job injuries are certainly common and visible, employer benefits are often comprised of several subtypes. They might offer a general group short-term or long-term disability policy.
But they almost always include or rely very heavily upon workers' compensation.
Right. And workers' compensation, you hear it called workman's comp, or compo in some places. It is frequently misunderstood.
People confuse it with comprehensive disability insurance.
All the time. But it has an extremely limited scope, even though it provides very comprehensive benefits within that scope.
Okay, what is that scope?
Workers' comp offers payments to employees who are usually temporarily, but sometimes permanently, unable to work because of a job-related injury or illness.
The key phrase there being job-related.
That's the whole thing. It's a risk management system tied specifically to the workplace environment and the employment contract.
And when we analyze workers' comp, we see that it's far more than just income protection. According to our sources, it functions as a single system with 3 distinct simultaneous purposes.
The first is that it compensates for economic loss, so both past wages and potential future earnings lost because of the injury.
Okay.
Second, and this is crucial, it reimburses or pays for medical and life expenses. So it functions as a form of health insurance, but specifically covering the injury and the rehabilitation.
And third.
Third, it provides benefits to dependents of workers who are killed during employment. So it offers a limited form of life insurance. It's a multifaceted system tailored entirely to employment-related injury.
But here is the critical limitation. The absolute aha moment that everyone needs to internalize when they're planning their finances.
This is the big one.
Workers' compensation provides no coverage to those not working.
This is the fundamental differentiator that justifies every single private IDI policy ever sold. The statistics show that most disabilities occur while the injured person is not working.
So they might be in a car accident on the weekend.
Or suffering a chronic illness that develops at home, or getting injured during a recreational activity like skiing or cycling.
And since the vast majority of debilitating accidents and illnesses happen outside the workplace, they're simply not covered by workers' compensation.
At all. And that immediately demonstrates why relying solely on your employer's workers' comp scheme is, frankly, financial malpractice.
You need that private, individual, or group LTD policy that covers you 204/7 for any cause.
That makes the distinction crystal clear. Workers' comp covers the accident tied to the job and its environment. General DI covers the inability to perform the work itself, regardless of where or how the injury or illness occurred.
We've spent a lot of time on definitions, mechanics, and financial planning. Now, let's pivot to a specific, highly detailed case study that really uses the source material to illustrate the real-world complexities and frustrations of navigating these national disability benefits under immense strain.
Okay.
And that's the situation faced by American veterans returning from war.
This specific information comes from some in-depth 2007 reporting. It focuses on American veterans of the Afghanistan and Iraq wars and their struggles to receive Veterans Affairs or VA benefits.
And it serves as a sobering, almost painful look at how these massive government safety nets operate when they're overwhelmed by acute, high-volume need.
It does. The sources documented immense difficulty and frustration, particularly around bureaucratic delays and just the wait times.
And this wasn't just a matter of waiting a few weeks. The reporting cited the specific anecdote of one veteran who had to wait an astounding 17 months.
17 months.
That is nearly a year and a half just to start receiving his initial payments.
Imagine that reality. A veteran returns, they're burdened with physical wounds, maybe PTSD, maybe both, which make returning to civilian employment impossible.
And they're trying to manage recovery, medical appointments, often psychological rehabilitation.
All without an income stream for 17 months. The bureaucratic hurdle itself becomes a serious impediment to recovery and just stable living.
And beyond the sheer length of the waits, the reporting highlighted vast variation in the outcomes. So a veteran's situation depended heavily on their state of residence.
Right. And that geographic disparity alone points to a systemic breakdown in consistency. The quality and the speed of the aid you got was dependent on where you happen to live, not on the severity of your wounds.
Furthermore, the outcomes varied significantly based on whether the veteran had served in the active Army, the National Guard, or the reserves.
And that variation suggests that the path to claim approval was not uniform across all the service branches, which adds even more layers of complexity.
So for those who were reservists or in the Guard, their connection to the full-time administrative infrastructure of the Army was often weaker.
Which could potentially delay or complicate their claims process. It's another hurdle.
The sources describe the whole claim approval process as being fraught with difficulty. And for many veterans who were burdened with severe wounds, these benefits were, at least initially, their sole income.
Right. Their only source of money.
So the inability of the system to process these claims efficiently meant that the administrative hurdles effectively created a secondary financial and emotional trauma right on top of their physical injuries.
Think about the added stress of trying to file complex forms and appeal denials while you're also recovering from a serious wound or dealing with severe PTSD.
The administrative burden on these disability programs, whether it's SSDI or the VA, is one of the greatest challenges to the system's utility.
Absolutely. A claim involving a visible injury, like the loss of a limb, that might be clear-cut. But complex claims, things related to traumatic brain injury, TBI, or post-traumatic stress disorder, PTSD,
They often involve these lengthy medical reviews, subjective criteria.
which just further exacerbate those long wait times.
To really understand the scale of the benefit being discussed and the financial pressure these veterans were under, the source material provided some concrete financial data, and this is essential for grasping the actual cost of living versus the safety net that was being provided.
In 2007, a veteran with a 100% disability rating, so that means they were considered completely disabled under VA standards, they received about $2,400 a month.
And while that amount increased slightly if you had dependents, let's just contextualize that number.
Okay.
In 2007, $2,400 a month might barely cover a basic apartment rental, utilities, and minimal food in many high-cost areas of the U.S., especially near large military bases or cities.
It was truly a bare minimum safety net.
And for comparison, a 50% rating, which is still a significant life-altering but not total disability, that brought in around $700 a month.
Attempting to restart a civilian life, undergo rehabilitation, support a family on $700 a month, all while facing significant physical or mental limitations.
It's an impossible task. It really emphasizes how critical complementary private insurance or a strong spousal income becomes in that situation.
And we also have comparison data from 5 years later, which is helpful for analyzing the impact of inflation on that fixed income. The sources updated these figures to 2012.
And they showed a slow inflationary adjustment.
Very slow. The 100% rating had increased slightly to $2,673 a month, and the 50% rating increased to $797 a month for a single veteran.
Seeing those numbers side by side really demonstrates the constant challenge that is faced by anyone who is reliant on government disability benefits. The increases often lag way behind the true cost of living.
Which means that even as they receive benefits, their purchasing power is slowly eroding, trapping them in that low-income bracket we discussed earlier.
But the section concludes with a much broader and frankly a pretty sobering comparison noted in the source material.
It's a tough one.
For all the obstacles, the long wait times, the bureaucratic hurdles, and the sometimes inadequate monthly figures that were faced by injured Americans.
They would still likely receive much better compensation and health care than equally injured Afghan or Iraqi soldiers.
And that instantly puts the entire domestic challenge into a global context.
It does. It reminds us of the immense disparity in how nation-states value and treat their injured combatants, even when they're allied and fighting in the same conflicts.
It underscores the financial and logistical complexities of administering aid even in the most developed nations.
While simultaneously highlighting the dire situations faced by coalition partners globally.
We have covered a vast amount of ground in this deep dive into income protection. It's clear that this is a layered product. It's not a single one-size-fits-all policy.
Not at all. We started with the history, acknowledging that foundational role of 19th century accident insurance born on the railway platforms, which defined early risk assessment based on carriage class.
Then we moved into the modern private landscape, where we really scrutinized those four factors: the benefit level, the benefit period, the elimination period, and, most importantly, the definition of disability.
All the things that make individual disability insurance so tailored and so variable.
We dedicated significant time to defining that distinction between own occupation and any occupation.
And we showed how specialized coverage, like high-limit DI and business overhead expense policies, can protect both high earners and the infrastructure of small professional firms.
And then we emphasized the foundational safety nets, the broad social insurance programs like SSDI and SSI, which serve as the absolute floor designed to prevent abject poverty.
And we clearly differentiated those from the very limited scope of workers' compensation, highlighting that since most disabilities occur off the job, workers' comp is just utterly inadequate as a sole source of income protection.
Finally, we grounded all those concepts in that challenging case study of American veterans. We illustrated the real-world impact of administrative bureaucracy, geographic, and service branch inequities.
And the critical importance of those specific, yet often minimal monthly benefits as a sole source of income for injured service members.
So we have focused entirely on the system's ability to replace earned income.
That's right.
But as we wrap up, we need to return to a concept that was mentioned briefly in the source materials list of related topics, and that's total permanent disability, or TPD, insurance.
TPD takes the discussion far beyond simple income replacement.
How so?
When we talk about DI, we are usually discussing a situation where the claimant is expected to either recover or be supported until their retirement age. TPD coverage defines disability not just as an inability to perform those core work functions for a set period,
But as a permanent total incapacity, a lifelong state.
and this raises a profound and highly complex question that builds on everything we've dissected today. What are the societal, the legal, and the economic challenges posed by having to measure and compensate a lifelong state of non-productivity?
Right. When you shift from a temporary measure income replacement to compensating for a permanent total incapacity, the focus of the benefit has to shift entirely.
It does. The compensation is no longer just about replacing a paycheck. It's about compensating for the total loss of a productive future and the need for potentially lifelong care.
So how does that fundamental shift in definition require us to think differently about medical evaluation, actuarial risk, and the ethical responsibilities of society and insurers to support those who can never fully participate in the labor market again?
The financial and social modeling for TPD is completely different. It requires insurers to project claims payouts decades into the future. And that is the next level of this deep dive we leave for you to explore as you consider the true breadth of income protection.